So our panel today is going to address coopetition, so cooperating and competing in the financial technology industry. So one of my observations about fintech is because it's such a fast-moving area, because at least relative to other technology company industries, it doesn't have the friction that a number of other areas have, and so it really is an opportunity to have a really varied number of business models and approaches to the market. And so we have both two younger companies as well as two more mature companies who are going to talk about how that impacts their business. Before we get started, I just wanted to make one comment about fintech. I've seen a number of different industries over the years, and from an investor perspective, oftentimes these industries there's a huge psychological tailwind behind them, and there has been in fintech really for probably the last 4 or 5 years, up until probably mid-August last year when everyone became kind of really concerned about the area. And so now actually we are in kind of an investor lull. But what I tell both investors as well as companies is this is often the best time to either start or grow your business. When it is difficult to get capital, that's oftentimes when some of the best companies are built. So I'm very enthusiastic about the area, both today as well as going forward. So we'd like to kick it off with Hugh Cumming. Hugh's the CTO of D&H. D&H provides lending, payments, treasury, service solutions, as well as a number of other solutions, really to a vast array of financial services institutions, both large and small. So Hugh.
Thanks everyone, and I'm delighted to be here. And D&H probably isn't well known to everyone in the room, but we are the global leader in financial technologies for transaction banking, payments, and lending origination. We have over 8,000 clients worldwide, which gives us a unique perspective on what's happening in financial services and banking. But we haven't always looked this way. We didn't start the company as a software business. In fact, we've been around for over 140 years. We are the largest check manufacturing business, but over the last several years, we've transformed ourselves and now serve 39 of the world's top 50 banks, and that's been a decade of transformation for us. And what I wanted to talk today about is partnership, and the partnerships that are possible between large financial institutions, large fintech companies, and disruptive innovators in this new wave of financial disruption. So if you think about where we are today and what people talk about, the analysts, they'll say things like fintech startups are going to disrupt 25 to 30% of the banking value chain. That's pretty exciting if you're one of the 100 companies or so in the room today, but if you're a banker and running a small community bank in Amherst, New York, that'd be pretty scary, but maybe not. Because if you decided to be here, maybe that's why you're here. How do I partner for success? The truth is that the development of these alternative methods have already had a huge impact on financial services providers. And more than that, consumer behavior is what's really shifting with these new models. And it's an important shift because it's a shift away from long-term relationships with incumbent providers to ones that favor immediacy and autonomy and cost. And the question really that is being asked is not whether these disruptions we are witnessing will transform banking, because they've already started to do that, but how will they do so, and where will they find success, and then what role does the incumbent financial institution have in the new ecosystem being developed? It's this flattening of the industry, this broad move away from institution-centric to individual-centric models that is most fascinating with what's happening in financial technology. More and more bank services we're seeing being unbundled by startups, essentially broken up into their constituent parts, into the individual activities by companies that provide these services better than the banks. They do it better, they do it cheaper, they do it faster, and that's where the real disruption is coming from, is that it's introducing a new set of choices. Thousands of startups are coming in and disrupting the business models, the distribution, the experiences, and introducing services that put the consumer first. And not the institution, which is a big change in the way people think about financial services. And that's leaving a lot of the institutions flat-footed. It's leaving a lot of the incumbent suppliers flat-footed. And a lot of these companies are not just delivering software, they're delivering end-to-end services. So as you look out ahead, it's not really possible for the incumbents to continue to operate the way they've been operated, and that's creating some urgency to create some real partnerships. But the challenge with partnerships is there's a lot of hope and a lot of hype, and sometimes these things don't always turn out the way people want them to. There's no shortage of buzz around this, and large organizations and startups have some complementary areas. So, in terms of access to capital, existing customers, knowledge of the regulations, these are all things that can really benefit through the partnership. It can often seem like a match made in heaven, but the reality is far from it. There's a lot of things to think about before partnering. And one of the big things that we think about is, in the challenge of partnering is that banks really can't think like a tech company. It's just not possible. And the startups, although they're much smaller and nimbler, they're bringing new technology and new ways of working together with machine learning, big data, mobile first. And this is the long-term change that we're seeing, and it's the long-term threat to disrupt banking. But no matter what, in the long run, we see an ecosystem evolving. We see an ecosystem of large players, of financial institutions and startups, and services that were historically delivered from a single institution being delivered through a network of players, a network of providers that really flattens out the way financial services are delivering. We see payments. Unequivocally, the payment ecosystem will be disrupted and be different tomorrow than it is today, and a large part of that will be the effect that blockchain is having. I think it'll be one of the most transformative forces, and new networks that replace things like the ACH network today will start forming between financial institutions as they get more comfortable with this new wave of technology. These technology currents are changing the way that services are delivered to customers, expanding the boundaries of risk. They're also opening up new avenues to connect. But that isn't to say that the current players will survive by partnering, because increased choice for consumers will create winners and losers. No matter what, traditional institutions that survive this shift will be more agile and responsive. And as we look at the road ahead, there'll be many casualties. Regulatory scrutiny may be the catalyst that drives these divergent forces together. We're seeing a 10x increase in oversight in our own business, and this sometimes will be a cost that's just too much for companies to bear on their own. As the saying goes, innovate or die, because great companies learn to disrupt themselves. Everyone, especially incumbents, need to be prepared to think big, catch the next wave. The stakes are high, the risks are significant, and with that, I wanted to pass this off to the group of panelists to get their thoughts on the risks and opportunities of partnerships. Thank you.
Okay, thank you, Hugh. And a bunch of interesting questions come out of that we're going to save for the panel. But I would encourage you guys to think about the questions that you might pose. But the number one question in my mind is with partnerships, what makes them work and what does not make them work? Because I think we do, as Hugh said, we get excited about these partnerships. But a small number of them, we get really excited about them, but a small number of them actually end up working. And so what does it take to make those partnerships work? So Garrett, I'd like to introduce you, Garrett Smith, the founder of the Opportunity Network. What Garrett's company does is he connects clients with many of the world's top financial institutions. And what he runs is a digital business matchmaking platform for partnering with banks. Welcome, Garrett.
Thank you, Jim. And thank you all for being here this morning. Let's make sure we get the presentation up here. So, as Jim mentioned, we are a digital business matchmaking platform whereby we establish partnerships with leading financial institutions, whereby they can offer access to our network to initiate peer-to-peer proprietary deal flow. As those clients are active within our network, we are aggregating that data together and we are giving it back to the bank so that the bank has a better understanding of what products and services their clients need. So there's been a lot of talk around the fragmentation of the IT systems, compartmentalization of data, and of course the regulatory burden, so I'm not going to go into a lot of detail there. But what I will do is talk about the strengths that banks have and the strengths that fintechs have. Now, banks have what appears to be a bottomless pit for resources when it comes to legal and compliance. They have a tremendous amount of precedent. They have influence in the regulatory frameworks. And that, to me, is a strength. Whereas on the flip side, you have fintechs and our ability to innovate quickly and bring products to market for very specific client segments. Now, when you combine those two together, you're able to not only leverage the resources of the bank, but the nimbleness of the fintechs to bring products to market very quickly. And as you're bringing those products to market, you can determine which create value for the clients, and you can determine which don't. Those that do, of course, you can leverage the bank's scale and then further innovate those products. The ones that don't, you drop them and you leave them behind. So essentially, by leveraging the resources of the banks and the ability for fintechs to innovate quickly, we can partner together to create value for clients. And fortunately, Opportunity Network has been lucky enough to be one of those products that has scaled. And the reason for that is that we've been able to unlock the underlying social fabric within financial services. Now, I'm sure all of you have been to a golf outing, a sporting event, maybe a cocktail gathering with the bank. And those are great events. You build relationships, you gain understanding of what your clients are looking for, and you get business done. Now, the problem there is that you can't bring 100,000 clients to a baseball game, so it's not scalable. And as a result, what you see is that deal makers have actually been driven to traditional social media channels to try and originate business development opportunities. And as you can see, 33% of deal makers are using social media, be it LinkedIn, be it Facebook. And the two biggest complaints they have is that they're outdated platforms, so those two companies were not designed for deal origination, and that there's no vetting. So when you connect to somebody on LinkedIn, I know me personally, when I get a request and I've never met the person before, my mind starts racing about who they are, where they come from, even if it's actually a real profile. So by tapping into that potential, I want to draw upon a case study, and this was one of our first partnerships with a bank. And within 6 months, and keep in mind at this point we had almost zero brand recognition when we launched the business, they onboarded over 3,000 corporate clients. And this was a hockey stick. So I would say about 75% of that was in the last 2 months. Those clients posted over 1,400 deals that in aggregate represented about $20 billion in proprietary deal flow. As a result, there were 4,200 connections between the users over those deals, and all of that information went directly back to the bank. So the bank understood exactly what types of services their client was going to need. Now, all of this can build trust, and I think we can all agree that there's a lack of trust within financial services, and there's two key areas that I want to touch on how this builds trust. The first is that there's been tremendous advances in consumer financial technology. There were a lot of companies up here yesterday that are doing amazing things. That hasn't transitioned to the corporate side of the house. So banks are really lagging behind in terms of offering their corporate clients unique digital products. And by doing so, you're demonstrating as a bank that you have their best interest in mind, that you're looking for ways to innovate so that you can bring digital channels to market so that they can be able to grow their business. And that builds trust. Now, the second area is that digital offerings generate data. And the importance of that data is that it is the right data. So I was having a conversation with the CEO of Honeywell, and he was telling me that they have tons of data. The biggest challenge is finding out which is actually useful. Now, if you give these corporate clients a channel by which they can share and connect with like-minded counterparties and tell you exactly what they want, instead of chasing them around the 18th green to push the product du jour and figure out what the hell they're trying to do, you can actually let them give you the information so that you're not pushing product, you're offering solutions as a bank. So in summary, I think that innovation within financial services has to take place incrementally because you're able to bring products to market more quickly and create more value and scale with those products. Those products need to be digital, and they need to be on offer for the corporates so that you can understand, as a bank, what types of products and services your clients want and how you can offer them solutions as opposed to just pushing more product. So I'll be here the rest of the day. I've got some of my team members. If any of the bankers would like to talk about our partnership methodology, and if you're a company, we'd love to have you in the network as well, and we can refer you to one of our bank partners. Thank you.
Thanks, Garrett. I always tell companies
Good
that
job.
you're half selling when you're making that sale. You're half selling your product and technology, and you're half selling your own personal credibility. So I think that trust issue is well taken. So our next speaker, Ronnie Khan. Ronnie is the Director of Marketing of DefenseStorm. And DefenseStorm is a cybersecurity platform that is built by bankers for bankers. Ronnie.
Thank you. Hi, thank you for having me. It's good to sponsor the event. So DefenseStorm is a security data platform. It was built by bankers for bankers, and it marries the technology with compliance that all of our banking customers need. So cybersecurity has changed, and even beyond banking, it's been painful, but especially for banking, right? You have the regulations that really no other industry has to deal with. There are more hackers out there every day trying to phish your executives into sending wire transfers, and now your bank board of directors are being held personally liable, right? We all learned a little something from Target on how that went down. We don't want to be the one who got. So community banks have some really unique challenges, but in talking to our customers, we see some very, very common threads. One of them is there are way too many types of solutions, right? You've got malware, you've got your IDP, you've got a million things that you need to monitor and watch. How do you do that with a minimal IT staff and maybe even 1 or 0 security people on staff? The other thing is there's compliance. Compliance is growing, it's changing. The FFIEC has put out new regulations that we all need to follow, and those are just going to get more and more strict. And then the last thing is limited budget. I know most of our customers are being, held to within their budget allowances from the regulators. They can't spend an additional $100,000 for no reason at all, right? They have to plan this properly. So DefenseStorm's been around for about 2 years. We were built by bankers for bankers, so our solution is unique. It fits the market. And it does that in a few ways. First off, it's a single platform that brings all of your cybersecurity solutions together. And it not only brings those together, but it's every device on your network, every application, every log file that you have comes into one system, and then it's tracked. So you have a single seamless system for detection, investigation, reporting, and compliance. So let's talk a little bit about that. You have to get your reporting together on a quarterly, annual basis to meet those FFIEC requirements. What if that information was all available to you real time and you didn't have to create reports? It was there and it was tracked, and every issue you'd had was laid out, so if an auditor had a question, you have all the data right there. And then lastly, it's great if it works, but it's got to be affordable. Looks like we have some slide issues. So we price based on assets under management, right? If you're a smaller community bank, you're going to pay a price that's appropriate for you. It also includes 24/7 security monitoring. Most community banks are in rural areas. They can't afford to hire somebody if they can attract the right talent out there. So marrying the technology with the people is the only way that we think our customers can be successful. So how does that happen? What are the pieces of the puzzle that come together to create it? So it starts out with SIM technology. So this is bringing all your logs into a single system using security information event management to monitor and analyze. You've got anomaly detection, you've got your threat feeds from InfraGard, you've got reporting, you've got your whole incident management, ticketing system and workflow, you've got asset management. And then lastly, we have our Guardian team, that security monitoring team of experts that helps support you in that 24/7 fashion. So these concepts are hard to put together, right? Cybersecurity is really hard to talk about. So we have an analogy that I think works really well. So picture your network like a shopping mall. You have your firewalls, IDS, IDP, covering the main entrances, the main places where people are getting in. Your AV and your malware is going to protect those big department stores, those big workstations and servers that you have out there. But it's not quite enough, right? What about all the interaction between the people, between the different machines, the different department stores? You need to see everything, and you need to be able to have anomaly detection on that in real time so you can find problems. All right, that's it. Thank you.
Thanks, Ronnie. Our last speaker, Chris Chen. Chris is the General Manager and Senior Vice President of APIs at Envestnet Yodlee, a company that, frankly, over the last 15 years, almost every time we've looked at a financial services investment, we've had some discussion of Yodlee because you guys occupy such an important part of the strategic part of the ecosystem there. So, Chris.
Thank you. So I've got about 5 or 6 minutes. I want to cover kind of a somewhat of a complex topic. Hopefully I'll do a good job of that while you absorb this amazing disclosure in front of you. So I think there's a couple things before we talk about partnerships. I think there's kind of a misperception in some circles, not all circles, of what fintech is. And I'd like to kind of give my own personal thoughts on what I think the advantages of fintech are, what the benefits are, and I think there are some confusion as to what that is. And then secondarily, what are the things that people maybe should be focused on in the future as we talk about fintech and the lessons from fintech before you even approach partnerships. So Envestnet Yodlee is kind of in a very unique position. We've been around 16 years. We are a leading financial data aggregator in the space. We have over 15,000 financial connections with banking, credit card data, all liabilities, assets, all those things. But I think what's unique about us and why partnerships matter to us is we've been sitting in the middle for a long time. We have over 500 financial institutions as clients, and we already have 500 fintech companies using our data. So in a lot of ways, this is kind of what the future of the ecosystem is going to look like. It's going to be a little bit messy. I think you've already seen competition straight out of the gates with fintech, but eventually there's going to be this co-opetition, these partnerships. It's going to be a little bit of give and take in the middle. And I think Yodlee has been in a very unique, driver's position to kind of see this happen already during our lifetime. So why do partnerships matter, and why is fintech kind of scaring folks? At the end of the day, not to pick on Yahoo, I think what really the question that everyone asks is, 5 or 10 years from now, will my bank be around? And I think that's the kind of underlying question that really drives fear in this industry. And when you really think about Yahoo, it's this, back in the day, it's this very large platform, a mile wide, maybe an inch deep, offering lots of products and services. The technologies weren't necessarily adopted over time. They got unbundled. People started going to different sites for very specific services. And you kind of start thinking about Yahoo in those terms. That's kind of a little bit what's happening in banking now, too. But I think the problem is right now there's a lot of fear in the industry. And when you have fear, the part of your brain automatically goes to fight or flight. That's your autonomic response. And I think what's more important is to not react and to really understand what's happening before you react. So I think the comprehension piece is what's missing. Sorry, we're having a little slide difficulties. I think what's really been focused on is UI, UX. There's the cost advantage in the fintech sector. People will say there's like a lack of regulation, there's a lack of security, and there's kind of also this broader fight over data rights. I would say actually most of this will solve itself over time. Listen, from a regulatory standpoint, most of these companies are incredibly small right now, and the regulators aren't going to pay attention. They're startups, their security is not going to be state of the industry yet. And then in terms of cost competition, they have a most of them have a monoline product. Of course, they're going to have a cost competitive advantage, right? Because they only do one thing and they do it really, really well. But I think these are kind of temporary smokescreen, and what folks are focused on are these things. But I would say over time, apologies again, we have slide difficulties, there's really going to be four things, right? A lot of people already talked about the UI UX advantage because of the focus on the user experience. That was going to be the first bucket. Second thing, which I think is incredibly important, is they use data in a competitive way that I don't think banks have quite gotten around to yet. And it's driving the user experience in a way that is incredibly powerful. So we'll talk about that more. People have already talked about the solutions versus a generic platform. I don't want to spend too much time. And the last piece, which is where the focus of the presentation, will also be on the idea of an open platform versus a closed platform. So banks are traditionally have been closed platforms, while the internet has been open. And so these two worlds are colliding, and it's kind of a philosophical question of what do you want to do, and you kind of have to figure that out first before you can even begin to partner. So the role of data. I would tell you the role of data over time is whether or not this banking data is the bank's data or fintech can use the data or not. What's really important here is not about the ownership, because the UK, the EU have already decided that it's the user's data, and I think that's where the United States will eventually fall out too. So I wouldn't focus too much on the ownership of data. I think it's what you do with the data is really important. If it's been hardware for the 90s, software for the last 15 years, I think the role of data in the next 15 to 20 years is going to be huge. And so being able to deal with data effectively is going to be very critical to being able to partner with folks as well as to drive your own business forward. So the funny thing is, if I were to tell you, who is the most effective person in using data, and I were to tell you that it started as a monoline lending company, they use data in a way that had never been previously contemplated, they had a strong focus on near and subprime customers in its early years, and now have leveraged its success into multiple product lines. I'm just curious if anyone would venture to guess here on who that would be. Exactly. And so fintech's really not new. It's coming at you at a wave. And I think the thing is not to take it so fearfully, but to really kind of dig in and see what some of these companies are doing at a basic operational level and focus on what the real long-term competitive advantages are. The last piece I want to address before I have to get off stage here is why open platforms are interesting. And so the extreme closed platform you have is an Apple device, right? They don't really work with anyone. They kind of control the entire user experience front to back. And then on the other side, you have Android, where it's open source. You can do whatever you want pretty much and add whatever you want. Now, banks have traditionally been closed. You curate your entire product line. Here's a set. This is what the user experience looks like. What I think, in order to compete in kind of the new age, is you probably need to be a little bit of both. You'll be closed in certain ways, and I think being completely open would potentially commoditize what it is that you offer. But at the same time, you'll have to kind of look internally and kind of figure out what is it I'm really good at and what is it that I'm not good at. Because what I guarantee what Yodlee has learned over time is if you open up a really good platform and you do have some amount of openness, innovators will develop choices for you. And you might realize I'm great at small business lending, but maybe I'm not so good at unsecured consumer lending. Maybe we should go find some partners. So in summary, what I would say is I think the two things that you have to really think about are, what am I going to do about my data? Because people are going to want to partner with me. They're going to want access to my data. And how am I going to use those analytics in order to drive a better user experience for my partners and my customers as well? And then lastly, kind of in this new world where you're being unbundled, you kind of do have to open your doors and become a little bit more of an open platform as opposed to a closed platform. So I think the takeaways for me is kind of watching the industry grow and this ecosystem grow is let's not focus on the kind of the temporary things that will eventually go away, like cost, regulation, and security. It's really about what are your long-term competitive advantages and figuring out what you're good at, what you're not, and then that's when you can begin to understand who you should be partnering with. Thanks.
Great. Come on up.
Thanks.
So to get the panel started here, we're going to cheat off of the last group a little bit. I'd like you guys to start and comment on one of my observations is technology companies have historically been in the business of selling to incumbents. But now what we're seeing is a lot of technology companies are building full stacks and going out and competing with those incumbents who historically they may have sold to. So I'm specifically thinking of Uber from our last panel, Airbnb, and it's certainly happening in the financial technology community. Do you guys think this is a long-term trend? Are we ultimately headed towards technology companies competing with banks, or this is just kind of a one-off special moment in time that we happen to be observing? Why don't we start at the end there?
Yeah, no, I think it's part of a long-term trend, and to borrow a phrase from Mark Andreessen, software is eating the world. How we think about that is, what he's really trying to say is that it's not just about selling software to banks anymore. That's why the companies that are, gaining momentum and gaining capital are the companies that are delivering an end-to-end solution. So I think it is part of a broad long-term shift away from enterprise software towards models where an end-to-end capability can be delivered faster, cheaper, with risk kind of built in. And that's one of the things that we're talking about today is what does that mean from a partnership perspective? Because it's no longer about vendor supplier. It really is about partners to deliver the services that banks want to deliver to their customers.
So in your model, the bank is not the technology company, but it's really important for them to partner with a really strong technology company and essentially white label that technology. Is that fair?
Yeah, white label, or depends on whether it's branded. We certainly provide a number of solutions to banks that they white label, and we're delivering the end-to-end outcome for them.
Ronnie?
I would definitely agree with that. I think it's adapt or die. Banks will take two paths. They will either adapt or they will be run out of the market by companies that are moving faster than they are. And there are definitely banks out there that are doing this really, really well. We have a customer, Live Oak Bank. They do mainly small business lending. They're a completely online bank. The way they structure their business is sharp and it's savvy. It's cost efficient. Their customers are very happy. And that model is going to continue to grow. Excuse me. So whether they choose to do it themselves, like Live Oak has, or they choose to partner with best of breed companies, it kind of doesn't matter. There will be room for both, but the option to adapt is not really an option.
Garrett?
Yeah, so I just draw upon a panel from yesterday, and what banks have is a charter, and fintechs, most of them do not. And so that's something that can be monetized. And I think that a fintech's willingness to deal with the regulatory environment in order to get themselves a charter, I think that remains to be seen. So I would say it may happen, but over a longer term. And just to address the Uber point specifically, Uber was a taxi dispatch system on a mobile phone. It wasn't like it was something hugely innovative when it started. And essentially, they're using a lot of the same infrastructure that the taxi system has. So it's the same drivers, maybe it's new cars, but it's the same passengers as well. So that's obviously a much easier industry to disrupt because a taxi license is much different than a bank charter.
I think from my perspective, you're going to have a little bit of everything. The unit economics, I think, the Lending Club and Prospers of the world came out, and while there's a lot of adoption in that market, I think we've seen the customer acquisition costs have gone up and the loans have not been as competitive recently. And so you're starting to see a lot of more white label plays in the industry where they want to partner with the banks because at the end of the day, realize, yes, mobile's great, but 90% of our deposits and our customers are still in the physical banks. And to your point, they have charters and people feel safe because they have FDIC insurance. So I think you're going to continue to see, monoline plays, direct to consumer, and you'll also see this banking as a service open up, right? You already have companies like Bancorp, these industrial banks out of Utah who kind of lend their back end to a lot of these services. And I think that's the infrastructure of payments and regulation and all the other stuff. I think you're going to see more and more investments come out of that area. So, fast forward 5 or 10 years, is a Google or a Facebook possibly going to get into financial services and create kind of like this banking platform? Maybe one company does that. Maybe it's Apple, who knows? But I still think you're going to see banks survive. They just may not look the way they do today.
Yeah, actually an interesting comment on that. I was sitting with a Goldman CIO a couple days ago, and 2/3 of his budget was actually software developers. The amount of money in his budget that was spent on licensed software was something, I believe it was 5-10%. So that was a striking, it's a technology company, but those are striking numbers. So let's assume the partnering path. What actually is it that makes somebody a good partner? And we kind of have the technology company angle on what makes a bank a good partner, but I'd love for those who are in banks in the audience to think about what is it that makes a technology company a good partner for you, and would love to hear you guys also weigh in on that. But what do you look for when you're finding a bank and you want that bank to be a good partner to you? What makes that bank a good partner?
I'll take it from the fintech angle, from maybe for some of the clients that we work with. I think from their perspective, listen, these are young technology companies, and they can be a little bit brash and off-putting at times. But really, I think they bring the technology, and you're going to bring the subject matter expertise. And I think that's kind of a conversation that needs to happen. They're not going to have world-class security. They probably never passed a bank-level audit. They don't understand all the security and the compliance yet. But if you're willing to kind of fill that gap and give them kind of that MVP, that proof of concept that you're really itching for, the pain point that you need to help them solve, and you're willing to kind of lend that sort of knowledge, I think they can bring the technology and the know-how and how to get to market quickly and bring a product that helps out your customers.
So you're encouraging risk-taking on kind of the credibility and security compliance aspects of that?
To a certain degree. I mean, I think you can always, I understand banks, there's always going to be risk in anything that you do, but I certainly think you could structure a pilot that is less risky in a way that if something happens, it's contained, there's not too much fallout. But I also think if you're unwilling to take risks, it's going to be difficult to work with startups.
Any bankers have any comments on that? That's yeah. We want to know what risks you're willing to take.
Well, you know what? I think, first of all, we have to follow all the regs. And what I think all the fintech companies should understand is, number one, we all have to have a vendor management policy. So any third party that we do business with, we have to follow this vendor management policy. And there's certain things that we have to do our due diligence in the vendor management policy. And so I think fintech should understand our compliance problems, because when I go to a fintech company or any other vendor, I want you to understand that you know and you appreciate the compliance burdens I'm under. And you should do your homework and read those regs just like I have to, and you should know what I have to deal with. And then within your technology, how have you figured out how to satisfy that need? That's one of the reasons I'm really interested in more reg tech as well.
And so I saw some heads bobbing there saying, yes, would you preclude a vendor with great technology that did not come with that understanding? Would you?
If I could add a point onto that, I think that's actually one of the key aspects of partnerships that, when we talk about long-term success of a partnership, it's great to do something that isn't, touching the back end of the bank. It, demonstrates utility in a use case, but the real successful partnership is going to be able to deliver real value to real clients, and that's going to come, right against, how do we work together well to solve the compliance challenges. And I think that's the real test of the partnership is, can the two organizations pass the compliance hurdle? Because there's no other way to deliver a service to a client.
Yeah, I just want to add on, my point is not to avoid regulation and to ignore it, but I think you need to have the conversation, right? They won't have it all figured out from day one. I think you have to be able to have that conversation, be open-minded enough to say, I love the technology, but if you can give me X, Y, and Z in addition to that, then we can have a deeper conversation.
Yeah, and I think if I can just comment on that, the gentleman's point there is that we take a very collaborative approach. And the banks that we work with that we like is of course the ones that can deliver scale because the value is created exponentially within our network if the more people that join. That being said, there also needs to be a willingness for the banks to help us understand the regulations that you're dealing with. So we've talked with a lot of banks who literally you go in and you talk to the chief compliance officer. He gives you the red X, he says, no, we can't do this, but then he doesn't explain why. And to my point earlier on my presentation, I mean, we're nimble enough to the extent that, look, if you can distribute my product to 100,000 clients, you better be sure that if you explain to me what we're bumping up against from a regulatory perspective, I'm going to go back to my office and I'm going to figure that out, and then I'm going to come back 2 days later, and then I'm going to have a solution for you. So, I mean, I think it's definitely a two-way street. And to your point, yeah, I mean, fintechs tend to be a little bit brash, especially the ones that are going direct to consumers. But the flip side of that is that fintechs have a hard time building trust with those consumers. So there's a lot of products out there that, you know, you sign up and it sounds great in theory, and then they ask you for every single piece of your financial history. And all of a sudden you're saying, wait, why is this company asking for all my personal information? And I don't even know, okay, they got a Series A of 6 million from Jim, but I don't know if they're going to be around tomorrow, you know, and then they're going to have all my information.
Who knows?
You know, it is a push and pull.
I think we had another comment from the audience. Yeah.
Thank you. There has to be dialogue between bank and fintech. One of the challenges I think that does have to be addressed is the cookie-cutter, one-size-fits-all vendor risk management approach that some banks are taking. Because the reality is, depending on what it is you're doing, the risk is greater or less. Are we introducing massive reputational risk? Are we introducing, there's so many kinds of operational risks that need to be addressed. Third-party risk management is very difficult, so fintechs need to understand that. To the point made earlier, they're not going to know the ins and outs of it. Reading the regs is a good idea, but it won't give you the whole story. But in reality, within the bounds that regulators will permit, a risk-based approach to vendor management has to start to emerge, and there isn't a whole lot of that going on right now, I think.
And more question here? A comment? Please, yeah, you can go ahead and go ahead.
Okay, here we go. Then I don't have to stand. So I want to agree with what you're saying and just push back a little bit on if the vendor can't comply with what you have to do inside of a big bank, only if you don't want to remain competitive going forward. So we have an innovation strategy management platform. We're helping the biggest banks across the world manage these complex strategies. One of the things we've done is benchmark most of the big global banks. And those that have a streamlined vendor process for startups are out-competing the rest of the banks on a number of fronts. You can get to market faster, your customers are happier, the employees are happier, you're more innovative on many, many fronts. So I would suggest that instead of saying you have to comply to the way we're doing it, is to have that dialogue and look for where those compromises are and do the POCs. I mean, that you can streamline with minimum risks and then make the decision if you're going to have the longer term relationship and have that competitive advantage with that commercialization opportunity in the market.
Great.
Yeah, I'll just add on to that. We had a bank that, loved what we were doing, and we went through the vendor management. They said, wait, there's this shortfall, this shortfall, this shortfall. And I just said, what I need is a shopping list. And she said, here are 6 things, get them done. And I got 4.5 done, called her up and said, I've got these 4.5 done. I flew down. They said, yeah, here's the plan to get, the other half and to the end of the list, and that was it. So it's a mentality of wanting to innovate as a bank and having a little bit of a proactive approach with your internal management. And I was in the banking business for 14 years and read credit policies for 2 banks, so I get the whole mentality, but you have to want to get up the hill, and you have to want to go to the CEO's office and say, yeah, we need this technology. Yes, there's a little bit of risk, but here's the plan around the risk, right?
Okay, so that's a great point. Go ahead, Ronnie.
Cybersecurity touches on this in a really, really unique way. So I wanted to give maybe a couple of practical, tips and tricks for the fintech companies out there who have to, adhere to these cybersecurity processes. So the FFIEC has very detailed information on what you need to do for third-party vendor management when it comes to cybersecurity. So they have a big old document. It's called the Cybersecurity Assessment Tool. It lists out a series of questions, and it lists them out for baseline, so those real small community banks all the way up to innovative, shocking, which the Wells Fargos of the world are going to have to adhere to, right? And it's a sliding scale for how big you are. So depending on what type of customer you want to tackle, You know what points you need to hit. You know what boxes your bank is going to need to check off. So I highly suggest you take a look at that. The other thing is the banking world is unique, which is why we're so proud of being founded by bankers for bankers. And because we know some of those regulations, we know that it's hard. So in addition to checking those boxes, I would also recommend getting a really strong due diligence package put together in advance, because pretty much every single bank is going to need the same thing. Package it up, make it look pretty. That's the best way for you to appear not as a startup, but as a more polished, professional company. And then the last thing are your audits, right? So in our world, we have to do SOC audits. So there's type 1, there's type 2. Make sure that you've completed them. The type 1 is a snapshot in time. The type 2 takes upwards of a year to complete. So when we tell customers, we've got a SOC 2 type 2 audit completed, we're good, they give us the thumbs up. And it's gets you in the door faster than anything else I've seen.
Okay, so I notice a theme running through some of these comments, which is, what risks are you willing to take in order to partner with a technology company? So it seems like, okay, one more comment
Sorry,
there? Yeah.
no problem. Sorry, just one more question. Caroline Vaughan from Innovate Finance. We're out in London, and we actually have an entire ecosystem based on collaboration between large institutions and small startups. And a lot of what I'm hearing is the comment on vendor, and I would say that Fintech is vendor by a new name. So there's the acquisition strategy. It's a solutions-based approach. But my question is more to the banks, which is help the startup community understand who to go to, what your needs are, and on a more public basis. A lot around the opportunity network. I'm actually interested to hear more about how you do it. It's a collaboration between banks to foster innovation within the whole community and be very transparent about what you need up front. So it's back to you. You want them to know what you need, but also they want to know it's a partnership. And so that's what I would actually put forward. So thank you.
Well, it sounds like this is a hot topic here. I think we could even have a working session to figure out what it is to make technology companies and banks work better together here. Now, one of the things that I would guess is would make that partnership more effective is hitting a value proposition that motivates the bank. And so my second question here is, between value propositions or partnerships that drive the top line, that are revenue drivers, versus value propositions that are cost savers, that are bottom line value propositions, total cost of ownership type value propositions. Do you find one or the other works better, both in terms of attracting the bank as a partner, and then as well as executing the partnership? And Hugh, why don't you go ahead and start?
Yeah, I mean, I think there's two ways to think about that question, because depending on the cycle that we're going through, certainly if you thought about 2008, 2009, the chief compliance officer was making all the big decisions. As you get out of that cycle, the role of the chief marketing officer and the lens shifts towards customer acquisition. And so I think there's no single answer that says, what the key driver is. I think it's very topical for the cycle that we're in, but also for, the overall trends. So we're seeing a lot of motion where organizations are increasingly adopting, digital acquisition strategies in terms of bringing in new clients, and that's not a trend that we would think is going to stop. That really isn't something that's going to be driven by the chief compliance officer. But at the same time, the compliance trends, increase regulatory oversight. So we have gone from having auditors on site for 30 days a year to 600 audit days a year, so just in terms of the services we provide. So that's, top of mind, and that's why we started the conversation with, make sure that whatever we're doing as a partnership, results in compliance.
Ronnie, when you guys go out and pitch customers, what do you pitch? Top line, bottom line?
So we chatted about this a little bit earlier. For us, it's both, right? We have the community banks who need to go out there and look their customers in the eye when they see them at the grocery store and say, I'm doing everything I can to keep your data and your money safe. But really, it comes down to the less sexier side of doing the nuts and bolts you need to do to keep your bank compliant, keep things safe, and move things forward. Cybersecurity is an expenditure 15 years ago that people did not anticipate, right? So how do you get them to pay a lot of money for maybe 20, 30 solutions, even at a small different bank? and do that in a cost-effective way. So it's really about how do we aggregate things together? How do we streamline costs? How do we make it more efficient? And that's where we're at in the cybersecurity field. It's been out there for about 10 years now. People have it. Now it's consolidation and it's efficiency.
Garrett, I have to imagine you guys are top-line driven.
All the way. But what I will say is that when having conversations, particularly with bankers who interface directly with the clients, the conversation is always, wow, this is a great tool. I'd love to give this to my clients. Can you send me the licenses that I can then distribute? And my response is, well, first we need to establish a partnership, and we need to get that approved by the legal and compliance. And then we shake hands, I leave, and I never hear from them again. And the reason for that is that they're so scared of their compliance groups and their legal groups. And I mean, you mentioned Goldman. I think 60% of their staff has a law degree. So they may be a tech company, but they're heavy on legal and compliance. So, you know, when the bankers think about the top line growth, especially ones that are dealing directly with the clients, they love the product, they can touch it, they can feel it, they want the information. But as soon as they understand that that requires them to go through a legal and compliance process, that's when kind of the wheels come off. So for us, in our partnership model, I mean, we have to engage across the board. We have to be engaging legal compliance, we have to be engaging management, and we have to be building use cases with the clients and the bankers so that all of that can be packaged together with a pretty due diligence package and submitted to the people that can sign it off.
And Chris, at Yodlee, do you guys tend to work on projects that have a top-line strategic motivation, or do they tend to be more long-term cost savings?
Yeah, I'd say it's both. I think it'll depend on the use case at the bank. So we work with Cabbage very closely. They're a partner of ours, and they're basically addressing a market that kind of went away in 2008, 2009 timeframe. So when they go to banks, it's all top line. It's like, here's an audience that you are not addressing very well, or it's underserved. Like, this is all revenue, dude. This is all gravy. While on the other side, we're doing some interesting projects in the mortgage area, and you know, the average loan document is 500 pages, and that's incredibly regulated by the GSEs, Fannie and Freddie. They're trying to take paperwork out of the process, but each layer of page of paperwork you take out, you're taking out a vendor in the middle or someone who gets paid to do something like that. But that's absolutely the goal in that industry is they want to take paperwork out, which in turn means cost, operations, and friction.
So I'd love to hear from any of the bankers in the crowd. Are you more willing to take the risk when it's something that's a revenue driver, or are you more willing to take the risk when it's a cost-saving kind of value proposition? Does anybody lean one way or the other? Anyone? 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 Okay.
I'm willing to take the risk if I feel like I can substantiate what I need to the
On either side of the ledger there.
You know, the regulatory regimes, they're very interesting. They have, and I don't really like the way they've addressed this because I think it's limited banks in fintech, but they said, you know, sure, you can bring in all these fintechs, but, you know, we're going to use our principles, rules, and apply it to social media, fintech, and the nine. And so if you can get it into their box, then, you know, let's go. And I think that is possible.
My observation from working with smaller companies is if you come in with a top-line value proposition, that your customer tends to move more quickly. That it's a 12-month sales cycle when it's cost savings, that it maybe is a 3-month sales cycle when it's top-line. But you know, everybody has their flavor. Next topic. So deposits versus technology. When you think about kind of the two kind of core value propositions that each side kind of brings to the table, technology companies obviously have little to no deposits, little to no capital relative to a bank, but they tend to be very technology rich. So where is it in that equation, do you think we're going to look back 10 years from now, 15 years from now, where did the ultimate power lie? Connection with the customer and deposits / access to capital? Or is this truly becoming an industry that is all about technology?
Yeah, that's a big question. I mean, if you look over the long cycle, when people start talking about blockchain and start talking about distributed ledgers, institutionless, the world of financial currency without banks. I mean, that's you're looking out a very, very long way. But I think if you think about what the next 10 years comes from. Banks have always been good at figuring out how to do more with the money people have put inside their vaults, right? So that's the essence of a bank, is if someone gives me deposits, I'm going to figure out how to monetize that in a lot of different ways. And I think that's what really makes the reality and the requirement for partnership so great, is that, you know, banks, for them to continue to grow and to deliver value back to their shareholders, they need to find new and innovative ways to monetize the deposits that they hold. So I don't see one or the other. I think that's a driving force, and that's always been a driving force in banking.
Sounds like a very good partner. Ronnie.
Well, heading up marketing for Defense Storm, I'm always going to default to it's all about the customer, right? You put your customer at the center, and then technology is the way you enable the online access, the ease of use, giving it to them in the way they want it, right? I can't tell you the last time I set foot in a bank, but I was on my banking mobile app yesterday and the day before that. So think about what your customer needs, use the technology to enable that, and I think that's the best path to success.
Garrett.
Yeah, I would add that, you know, if you think about the millennials, you often hear that they're more comfortable receiving financial services from a Google or an Apple or a Facebook. And that goes back to trust. It goes back to trust in the brand. Now, if Google, Apple, or Facebook were to, let's say, get a bank charter and begin offering financial services, the first thing that they would do is hire a bunch of bankers. And bankers, the environment may have changed, but the way that banks look at a new technology value proposition, yes, there's compliance, but there's also ROI. That's never changed. So if they're going to invest in a technology, what's the return going to be like? And so I think that, yes, it's going to be moving more towards the technology-driven bank, and it's going to be more open in terms of it being a platform. But I don't see that kind of depository and credit side of it going away.
Honestly, I'm probably not smart enough to be able to answer the question. What I would say is this, and I think someone pointed this out yesterday, was until you are able to separate the bank from the paycheck deposit, that's a relationship that's going to be pretty sacred. So I don't think fintech's gotten to the place where they either have the FDIC insurance, the charter, the regs, all the compliance, the trust, and the safety. Will we get there one day? I bet a couple companies will. But until you're able to consistently convince people to put their paychecks somewhere else, the banks will have a big role in this economy.
Yeah, it reminds me actually 10 years ago, or maybe even longer than that, the CLEC-ILEC debate. CLECs, there was all this excitement about competitive local exchange carriers, but everybody forgot that the incumbent local exchange carriers, they all owned the fiber. And so eventually the ILECs were there in the power position there. So the other thing that we see from a technology development point of view is that new technology has to deliver value in a really short time frame. So a customer is no longer willing to say, it's a 2-year project, we'll realize that value over 2 years, that they want to see value, and they want to see value right away. Is that something that you guys have also experienced? And if so, how is it that you deal with that? And Chris, why don't you lead us off there?
Sorry, can you repeat the...
The kind of time to value demand that customers have these days, my sense is it's become very short, that the requirements are they have to see value right away, that they're not willing to engage in longer projects. Is that something you have also experienced or not?
Yeah, I'd say, I mean, we have a very developer-focused, the team I run is actually very developer-focused, and because we run an open platform, so I'll talk from the perspective of almost the technology community. If you can't prove to them and they can't stand up a proof of concept within a few hours or a couple days or something, they're going to move on. If they don't get what it is that you're doing, they're very impatient because they're on a deadline and they want to see immediate results. So I think in the technology side of things, I absolutely agree that it's a very short cycle now.
And what is a short cycle to you guys?
I think developers, in their perspective, if they don't understand what it is, they can't get some sort of data or code out of your system within a couple hours, it's over.
Hours, okay.
The bounce rate, it's come to the point where e-commerce had its evolution 5 years ago or so and kind of continues to evolve. I think that sort of mentality is moving to other sectors as well, where it's like everything's a funnel, it's a shopping cart. You get me into the funnel, and you got to move me down as quickly as possible. Otherwise, I bounce and I'm gone.
Yep. Hugh, what do you see from your customers in terms of?
Yeah, I think one of the big conversations we're having with customers is they're asking us not to let them customize our solutions, and especially when we think about large enterprise payment hubs being installed at Barclays. They're coming to us saying we want the out of the box because it's the only way we're going to get value quickly. We want to deliver commercial in payments or ACH or wires in 3 months and not 18 months. And the only way to do that is that the willingness to just take the standard functionality. So we see that that's a big change in terms of how banks have been typically approaching their large enterprise vendors. The second big conversation we're having with all of our customers is around APIs. They want the flexibility to be able to assemble use cases on top of our solution, working with other people's solutions, and that's a big area of focus and investment for us.
I'm curious, how many bank owner operators in the audience are willing to engage in, say, a 12-month development cycle for a new project? 12 months is off the table. Okay.
Yeah.
Very good. Comments, Ronnie?
Yeah, I would definitely. Are we on? Okay. I would definitely agree with what Chris and Hugh said. I don't even think it's 2 years. I think if you can't, get your product up and running with the defaults within a couple of days, you've lost that credibility, you've lost that momentum with the sale. It's get it up, make it work, test, then customize, then iterate. I think we've all gotten familiar with agile development, and people have become more used to seeing that model. But really, it's keeping that customer's trust right from the beginning through the full onboarding process.
And Garrett, what are your rules of thumb in terms of time to value for customers?
Yeah, so our model is B2B2C. So our product is ready to go. It's kind of a one-trick pony. So there's not that much additional development that needs to take place in order to distribute it. What I would say is that in order for the banks to get it down through their channel into the hands of the customers, that's always a key conversation for us. So if it's a product that's actually going to touch the client, they want it. They're very conservative in terms of how it gets distributed through the channel. But as soon as the clients have it, then the bank wants immediate value. So that's been our experience.
Well, I'd like to thank the audience and the panel, as well as for your sponsorship and comments here. And I think there's a rich vein for exploration here in terms of partnerships between technology companies and banks. So thank you all.